Welcome back to the Deep Dive. Today we are taking a truly rigorous look at the machinery that drives modern financial engineering. We're talking about derivative securities. And this deep dive is really customized for you, the professional investor, the portfolio manager, or financial advisor. We want to help you transition from simply knowing what futures and options are to really understanding the analytical mechanics that govern them.
That's right.
Their valuation, their risk control capabilities, and of course, their strategic deployment.
Indeed. Our mission here isn't just definition, it's distillation.
Distillation, I like that.
We're trying to extract the core insights from some of the seminal work on options and futures. The goal is to provide that analytical framework you need for strategic deployment and effective risk management.
So it's very concept-driven.
Very. We have to maintain an analytical perspective, and that demands precision in our financial terminology. Ultimately, we're trying to understand that delicate interplay, the one that ensures these instruments derive their value and maintain an absolutely critical tight coupling with their underlying cash securities.
And that happens through continuous market-enforced arbitrage.
Exactly.
That coupling is really the only reason these markets work, isn't it?
It's everything.
I mean, if derivatives diverge from their theoretical fair value, market participants just instantly step in to correct that mispricing.
They force it back to equilibrium.
Right. So let's unpack the basic architecture. We can start with the foundational concepts and those arbitrage mechanics that link these derivatives to the underlying assets we all manage every day.
Let's do it. By definition, derivative securities are contracts whose value is, it's derived from the price movement of an underlying asset.
And that could be a stock, an equity index,
an interest rate benchmark, foreign exchange, you name it. The point is they aren't primary investments.
They're tools.
They're tools for exposure, for risk transfer, and of course for leverage.
And as you mentioned, the market enforces this theoretical fair pricing through some very strict arbitrage mechanisms. If the price of the derivative doesn't perfectly align with the underlying, a riskless profit opportunity is created.
It is.
The sources highlight two primary relationships that really stabilize this entire ecosystem.
That's right. For futures contracts, the stabilizer is something called the cash and carry arbitrage.
Right, cash and carry.
This relationship dictates the theoretical futures contract price. Let's call it F relative to the current spot price, S. The arbitrage mechanism involves simultaneously taking a long position in the cash asset and a short position in the futures contract.
Or the inverse, right, a reverse cash and carry.
Or the inverse, exactly.
So walk us through the mechanics of that cash and carry transaction. How is the profit made riskless?
Okay, so imagine the futures price is too high relative to the spot price.
Like a mispricing.
A clear mispricing. An arbitrager can execute a few steps. 1, they purchase the underlying cash security today at price S.
Okay.
2, they simultaneously sell the futures contract at that high price, S. And 3, they finance the purchase of that underlying security by borrowing funds at the riskless rate, R, until the futures contract expires.
So by combining the long cash position, which has price risk, with the short futures position, which also has price risk, you're saying the changes in value perfectly offset each other.
Perfectly. The price movement of the underlying asset is completely hedged. The cash flow at the end is known. It's the proceeds from selling the asset via the futures contract minus the repayment of the loan.
Which guarantees a fixed return.
It guarantees a fixed return, and that return must necessarily equal the cost of financing the transaction, plus any carrying costs minus any income generated, like dividends.
So if the return is greater than the riskless rate,
arbitrageurs execute the trade. And they do it until the buying pressure on the cash security and the selling pressure on the futures contract force those prices back into alignment.
And the riskless profit disappears.
It's gone.
That brings us to the second link. This one governs options and is absolutely foundational to their valuation. Put-call parity.
Put-call parity. This links the price of a call option C and a put option P, both with the identical strike price E and maturity T, to the price of the underlying security S0.
And if this relationship is violated,
then an investor can synthetically create a riskless asset or position that yields a return greater than the riskless rate.
How does that parity relationship establish a riskless position?
Well, the relationship states that the value of holding what's called a fiduciary call,
which is a long call option plus cash.
Right. Cash equal to the present value of the strike price. That value must equal the value of a protective put,
which is a long stock position plus a long put option.
Yeah, Correct. So if you structure a portfolio that simultaneously holds the stock, buys the put, and sells the call, that portfolio's value at expiration is guaranteed to be equal to the strike price E.
Regardless of where the stock price ends up.
It doesn't matter. So that means the current value of that complex synthetic portfolio must equal the present value of E, discounted at the riskless rate.
So for European options, the relationship C equals S0 plus P minus E divided by 1 plus RT that has to hold.
It must hold. And look, both cash and carry and put-call parity, these aren't just theoretical constructs.
No, they're happening every second of the trading day.
They are the continuous operational stabilizers that ensure professional investors can't just extract riskless profit. It's what makes the market efficient.
Let's move on to the market structure. These exchange-traded derivatives, they share some critical common characteristics that give portfolio managers significant operational advantages over trading the cash assets themselves. What makes them so efficient?
First and foremost is standardization. The contracts have fixed very clear features. They cover the size, the delivery specifics or cash settlement, and the expiration dates.
Everything is uniform.
It is. And this standardization is what enables them to trade so efficiently on organized exchanges like the CME, CBOE, or the CBT. This allows for scale and liquidity, which is, it's essential for institutional investors.
And crucially, the system offers some powerful operational efficiencies.
Immense.
If I need to adjust the equity exposure of a multi-billion-dollar fund by, say, 5%, executing that trade in the cash market involves moving thousands of individual stock positions.
And accruing huge transaction costs.
And disrupting your underlying long-term holdings. It's a mess.
Contrast that with derivatives. The operational advantages are huge. The ability to adjust market exposure quickly at vastly reduced transaction costs, same-day settlement, and maybe most importantly,
the ability to create specialized risk-return patterns.
Exactly. Tailoring duration or beta without ever disturbing the underlying management of the asset portfolio. Derivatives allow the manager to limit or transfer risk with minimal operational drag.
Let's get into the crucial distinction between the two main instruments then. Futures versus options. As a portfolio manager, the choice between them really dictates the fundamental structure of the risk you're assuming or transferring.
And the difference hinges entirely on one word: obligation.
Obligation.
A futures contract is a mutual agreement. The buyer has the obligation to take delivery or cash settle, and the seller has the obligation to deliver or cash settle.
At a specified price on a future date.
Right. Both parties are bound.
And because of that mutual obligation, the risk of default is paramount. It has to be managed. How is that achieved?
Primarily through the daily marking to market.
Okay.
This means that gains and losses are realized and transferred between the parties every single day. If the market moves against you, you have to post funds instantly.
It prevents...
Precisely. And furthermore, both the buyer and the seller have to post what's called initial margin.
A performance bond.
It's a performance bond, typically ranging from, say, 2 to 10% of the contract's value.
That initial margin is the secret to their power, isn't it? The sources point out the potential for just extreme leverage.
Oh, it's enormous.
If a contract is worth, say, $200,000 and the margin is $6,000, a tiny move in the underlying asset like 1% can generate a 17–18% gain on the margin?
The leverage factor can exceed 35 to 1.
Wow.
It creates enormous capital efficiency, but it requires meticulous daily monitoring of cash flows.
Because the moment you fail to meet a margin call,
your position is immediately liquidated. No questions asked. Now contrast that leverage and that obligation with the option contract. An option grants the buyer the right, but not the obligation, to purchase a call or sell a put at a specified strike price.
And that asymmetry of the option payoff changes the risk transfer equation completely.
Absolutely. The option buyer's liability is strictly limited to the premium paid for that option.
They can lose no more than their upfront cost.
That's it. However, the option seller, the writer, they assume the obligation, and therefore they take on risk profiles that can range from a limited loss for a covered position to unlimited liability for a naked short position.
Which is why they have margin requirements similar to futures.
Exactly. The systemic risk is transferred entirely from the buyer to the seller, who must then post margin to the clearinghouse to cover that potential unlimited liability.
And the trading mechanics differ a bit too,
They do. Futures traditionally use that open outcry system in centralized pits, but options rely more heavily on a specialized market maker system.
where designated traders provide continuous bid and asked quotes.
Right, which ensures liquidity and tighter spreads.
Yeah.
And that's necessary just due to the sheer variety of strikes and maturities that are available for options.
Okay, so with that foundation set, let's move into the analytical core, futures pricing. As we established, this is governed by that cash and carry relationship and the net cost of carry.
The fundamental relationship holds true. The fair futures price, F, is determined by the spot price, S adjusted for the net cost incurred by holding or carrying the underlying asset until the contract expires at time T.
And the precise relationship is?
F equals S plus interest, which is your opportunity cost, minus cash distributions like dividend or coupon income.
So for an investor, this means the futures price has to represent the cost of obtaining the asset today, holding it until expiration, and then accounting for all the associated cash flows.
That's it. And if the carrying costs are positive, the futures price is generally higher than the spot price.
A situation known as contango.
Right. And that compensation to the seller for the delayed settlement leads directly to this concept of the implied repo rate.
The market-derived financing rate that's embedded in the futures price.
Exactly. If we rearrange the futures pricing formula, we can isolate the rate of return an arbitrager earns by buying the spot and selling the future. And arbitrage ensures this implied rate approximates market riskless rates from, the short-term T-bill rate up to the Eurodollar rate.
So let's explore the implications of a deviation there. If the implied repo rate is significantly higher than the prevailing riskless borrowing rate, how does a professional portfolio manager exploit that?
Well, if the implied rate is too high, it just means the futures contract is overpriced relative to the spot asset and the cost of capital.
So you execute a cash and carry.
You do. The arbitrager sells the overpriced futures contract, so they're short F. They buy the spot asset, long S, and they borrow money at the lower prevailing market rate to finance S.
And their profit is just the difference between that high implied repo rate and their actual lower borrowing costs.
All locked in, risklessly, until expiration. And the sheer volume of this kind of arbitrage activity immediately drives down the futures price and pushes up the spot price until that implied rate normalizes.
And conversely, if the implied repo rate is too low, maybe below the T-bill rate, the futures contract is underpriced, and we see a reverse cash and carry.
Correct. The arbitrager would short the spot asset, if they can, buy the cheap futures contract, so they're a long F, and invest the proceeds from that short sale at the market's riskless rate,
Pushing the futures price back up.
and forcing the implied repo rate back up to equilibrium. The practical constraint, of course, is just the feasibility and the cost of short selling the underlying asset. That adds some friction to the whole process.
This simple pricing foundation becomes highly specialized depending on the asset class. Let's analyze some specific applications, starting with equity index futures, like the S&P 500.
For equity index futures, the futures price is almost always greater than the cash index price.
And that's because the interest opportunity cost
What you could earn by just investing the cash.
almost always exceeds the dividend yield of the index.
Right. And since there's no physical delivery, the formula simplifies, but the cost of carry still dominates. So F equals the index price plus interest minus the dividend income. The value of having that immediate liquidity in cash always tends to outweigh the dividend income you'd receive from holding the index.
Okay, now Treasury bond futures. These introduce a significant amount of optionality for the seller, which complicates the pricing through this cheapest to deliver, or CTD mechanism.
This is a really crucial area of complexity. The underlying instrument isn't a single bond.
It's a basket of eligible Treasury bonds.
It is. And to standardize the delivery, the exchange uses a delivery factor to normalize all those eligible bonds to a hypothetical 8% coupon band.
That normalization is essential.
But it grants the short seller a critically valuable option. The option to deliver the cheapest to deliver bond from that basket.
So the short seller has a choice of which bond to deliver, and they'll naturally choose the one that minimizes their cost upon delivery. How is that optionality reflected in the futures price?
Because the short seller will always choose the bond whose price, when adjusted by the delivery factor, is the lowest, the futures price is effectively tracking the least valuable bond available for delivery.
That optionality is valuable to the short position.
Very valuable. Which means the fair futures price is actually lower than it would be if the delivery bond were fixed. The formula reflects this. F equals the price of the CTD plus interest cost minus coupon income, all divided by the delivery factor.
So the CTD bond determines the entire contract's price dynamics.
It does. And if interest rates shift, a different bond can become the CTD, causing an abrupt and very sharp change in the futures contract's behavior.
Moving to the short end of the curve, we have money market futures, things like Eurodollars and T-bills, which are quoted as an index.
Right. These are quoted as an index. 100 minus the annualized forward rate. For a Eurodollar future, it's 100 minus F sub T, where F sub T is the 3-month forward rate expected at time Ts.
And arbitrage links these directly to the implied forward rates and the term structure?
Exactly. It forces cross-market consistency. The price of a future contract has to align with the implied forward rate you would calculate by just comparing today's 1-year yield and today's 3-month yield. If they didn't align, you could generate riskless profit just by borrowing and lending across different maturity buckets.
And finally, foreign currency futures, where the pricing reflects global interest rate differentials through covered interest arbitrage.
This is all governed by interest rate parity. The futures exchange rate, F, is the spot exchange rate, S, adjusted for the differential between domestic R sub D and foreign R sub F interest rates over time T.
So F equals S times the ratio of the interest rates.
The formula is F equals S times 1 plus RD times T, divided by 1 plus RF times T. The logic is just that the forward price has to compensate the investor for the opportunity cost of holding the foreign currency instead of the domestic one.
So if the foreign interest rate is lower than the domestic rate,
then the forward exchange rate has to be higher than the spot rate. It has to be at a premium to discourage that cross-border arbitrage.
understanding these complex relationships leads us directly into hedging strategies, which really live and die by the dynamics of the basis.
The basis. It's just the price difference between the spot and the futures price, S minus F. It is the explicit function of the net cost of carry.
And the essential principle for any hedger is convergence.
Right. As the contract approaches expiration, the basis must narrow to 0. At expiration, S has to equal F.
Which means the fundamental risk management principle of hedging isn't about eliminating risk entirely, but transforming it.
Precisely. By placing a hedge, you effectively lock in a future selling price. That price is equivalent to the initial futures price plus whatever the ending basis is.
So hedging reduces the full, unmanageable price risk to just basis risk.
The uncertainty surrounding the magnitude of the basis at the moment you terminate the hedge. Professional hedging is fundamentally basis speculation. It's a bet on the movement of the cost of carry over time.
The sources also detail the calendar spread, the difference between two futures contracts with different expiration dates, F2 minus F1. This is often a pure play on interest rate expectations.
Yes, the calendar spread is highly sensitive to the forward interest rate that exists between the two expiration periods. If the market anticipates a rise in short-term interest rates between time 1 and time 2, the deferred contract, F2, will become relatively more expensive than F1.
Causing the spread to widen.
It widens. A manager who is hedging long-term has to understand that any change in that forward-term structure directly impacts the cost of rolling their position.
This brings us to a crucial operational decision for hedgers, whose horizon, T, exceeds nearby expiration T1. It's the choice between a stack hedge and a strip hedge.
Right.
Let's assume a manager needs a 12-month hedge, but the available contracts are for 3 months F1 and 6 months F2.
This is a classic risk-return trade-off scenario. The stack hedge involves initiating the entire 12-month position using only the most deferred contract, F2, and just maintaining that position until termination.
So it's operationally simple.
Very simple. And it exposes the manager solely to the basis risk at termination. That's it.
But that deferred contract, F2, probably has lower liquidity and may not track the spot prices perfectly in the short run. What about the strip hedge?
The strip hedge is more complex. The manager starts with the nearby contract, F1, for 3 months, and then at some point, they execute a roll.
Simultaneously closing the nearby and opening the deferred.
Exactly. They buy back F1 and sell F2 for the remaining period, and they just repeat this process until they reach their target horizon.
The danger here is forward rollover risk. The final net price achieved by this strip strategy depends entirely on the calendar spread at the moment they execute that roll.
It does. The sources illustrate that the difference between the final price of the stack versus the strip is determined by the difference in the calendar spread between the initiation date and the roll date.
So what that spread is today versus what it is when you roll.
Yes. And since that spread is a function of the interest rate term structure, the strip exposes the hedger to the uncertainty of the forward interest rate environment at the roll date. If forward rates rise unexpectedly, the strip strategy might yield a worse final price than the stack.
So the professional choice boils down to whether you prefer the certainty of a known basis risk with the stack.
Or the risk of unknown future interest rate changes affecting the roll cost with the strip. It's a judgment call.
Moving to a more generalized framework for risk control. We often use a simple equal dollar match for hedging, but for precision, especially in cross-hedging, we have to calculate the minimum variance hedge ratio, or H. Why is this superior?
Well, simple dollar matching just assumes a perfect 1.0 correlation between the asset you're hedging and the derivative.
Which rarely happens in reality.
Almost never. The goal of sophisticated risk management is to minimize the residual risk, the variance of the hedged portfolio's value, by finding the optimal ratio of futures contracts to underlying assets.
And this is critical in a cross-hedge.
Absolutely. A cross-hedge is where the underlying security is a different asset class from the futures contract, like hedging a corporate bond portfolio using Treasury futures. The correlation is not one.
And the calculation for this ratio, it requires real-world statistical estimates.
It does. The minimum variance hedge ratio is defined as H equals negative rho, the correlation times the ratio of the standard deviations.
So correlation times sigma of the asset divided by sigma of the future.
Right. And the key insight is that when price movements aren't perfectly correlated, when rho is less than one, residual risk remains.
That's your unhedged variance, your basis risk.
And it's equal to the asset's variance times 1 minus rho squared. So the hedger converts full price risk into a calculated minimized basis risk.
This framework is also essential for dynamic asset allocation, allowing us to control exposure synthetically with precision.
Absolutely. The concepts of delta-neutral hedging and tactical asset allocation are just extensions of this minimum variance framework. For equity portfolios, for instance, the hedge ratio has to be adjusted not just for correlation, but for the portfolio's beta relative to the index futures.
And the equations let you determine the exact number of contracts needed to get from your current risk profile to a target one.
It's synthetically, yes. You can move a portfolio's current risk characteristics to a desired target without touching the underlying assets.
Give us an example of how this applies to a fixed income portfolio.
For fixed income, we control risk using duration. So if a manager wants to reduce their portfolio's current duration to a target duration, they calculate the required number of bond futures contracts needed to effectively shorten the portfolio's sensitivity to interest rate changes.
So you can do rapid, efficient duration management without having to liquidate or buy billions in cash bonds.
Which is crucial for managing short-term interest rate risk. It's a game changer.
We now transition from the linear world of futures to options, where the payoff structure fundamentally changes the game. This is where professional managers gain the ability to truly shape and mold return distributions. Let's begin with the option value components. Intrinsic value versus time value.
Every option premium is composed of two primary parts. The first is intrinsic value,
which is the immediate payoff if the option were exercised right now.
Right. For a call, that is the max of 0 or S minus E. For a put, it's the max of 0 or E minus S. If this value is positive, we say the option is in the money.
And the second component is the time value. This represents the premium paid above the intrinsic value.
And this value is essentially the market's price for optionality.
The possibility that the security price might move favorably before expiration.
Exactly. And the time value is dependent on three primary factors: the underlying security's volatility, or sigma, the current riskless interest rates, R, and the time remaining until expiration, T.
What's paramount for risk control is that this time value, it's always positive, and it gradually, inevitably, approaches 0 as expiration approaches.
That erosion of time value is known as theta decay, and its nonlinear rate of change is a critical risk factor to manage.
The key differentiating factor from futures is, as we said, the payoff asymmetry. The kinked structure of the option payoff allows for sophisticated risk shaping that linear instruments just can't achieve on their own. Let's look at how this asymmetry dictates some common portfolio strategies.
Okay. Consider the covered call strategy. You're longer the underlying security and simultaneously short a call option.
So you collect the premium.
You immediately collect the premium, which generates income, but in exchange, you truncate your upside potential. If the stock price rises above the strike price E, the portfolio's total value is capped at E plus whatever premium you received.
The strategic implication here is that you're selling optionality. The manager is essentially short volatility and is generating current income in exchange for sacrificing the potential for those extreme outsized gains.
Precisely. This strategy performs exceptionally well in stable, flat, or, moderately declining markets because the manager captures the time decay, the theta, and the premium income.
And analytically, this strategy draws the right tail of the return distribution back towards the mean.
It introduces negative skewness to the portfolio returns, and that systematically reduces the overall volatility of the portfolio.
Conversely, the protective put strategy provides what is essentially catastrophic insurance.
The protective put. This involves being long the security and buying a put option. The strategy establishes a price floor, a minimum selling price of E for the security.
And the cost is the premium you paid for the put.
Right. But in exchange, the investor limits their downside loss while preserving the full possibility of capturing high returns if the security price appreciates significantly.
In this case, the manager is buying optionality, which can be expensive, but is obviously highly desirable.
It truncates the left tail of the distribution. It eliminates the potential for catastrophic extreme losses.
So it introduces positive skewness.
It does. You maintain a positive bias for high returns while eliminating the deep negatives. This shape is exactly what risk-averse investors want.
Now, what about for managers who are speculating purely on volatility or anticipating a regime shift, regardless of the direction?
In that case, you'd deploy a straddle. The simultaneous purchase of a call and a put option, both having the same strike price, E, and maturity T.
This strategy is loss-making if the market stays stable.
It is. You lose both premiums you paid. It only profits if the price moves substantially up or down by more than the combined premiums. It is a pure direction-neutral speculation on anticipated high future volatility.
And finally, strategies designed for specific directional views, but with controlled and limited risk.
For that, we use spreads, something like the bull call spread. It's constructed by buying a call at a lower strike, E1, and selling a call at a higher strike, E2.
This strategy expresses bullish sentiment, but strictly limits the maximum loss.
And it strictly limits the maximum gain. This is vital for professional managers who seek defined, controlled risk exposure. It ensures that the possibility of a wrong forecast doesn't lead to a catastrophic loss.
Let's tie this back to portfolio performance attribution. The sources note some empirical observations about how these strategies affect standard risk-adjusted metrics, like the Sharpe and Treynor ratios. This is critical for fund reporting.
It is. The key insight for portfolio construction is the volatility reduction. Covered calls tend to move the portfolio to a higher risk-adjusted return relative to the capital market line.
And why is that?
Because the systematic reduction in volatility, that's the denominator of the Sharpe ratio, that results from selling the upside optionality often outweighs the slight reduction in mean return, which is the numerator. The strategy generates moderate, consistent income while significantly dampening volatility.
Yielding a potentially better Sharpe or Treynor ratio.
Potentially, yes.
And the protective put often does the reverse.
Yes. Buying protective puts, while it protects against disaster, means you're paying a known upfront premium. That drags down the portfolio's mean return, the numerator.
So even though the reduction in downside risk is valuable,
the cost often moves the portfolio below the capital market line on a standardized risk-adjusted basis.
So the professional choice of strategy, the strike price, the maturity, the type of spread, it all boils down to forecasting.
Entirely. The manager has to assess market expectation, bullish, bearish, neutral, and critically, they have to assess the option's expensiveness,
which is measured by its implied volatility.
Exactly. If options are deemed rich, meaning high implied volatility, then selling them in a covered call is attractive. If they're cheap, then buying them as a protective put offers valuable insurance at a discount. Optimizing the risk-adjusted return profile always requires judging the current volatility regime.
Let's turn now to the foundation of option valuation, starting again with put-call parity, but examining its analytical use in determining fair value and the critical question of early exercise for American options.
Right. Put-call parity, so C equals S0 plus P minus the present value of E, establishes the necessary relationship for European options. And this shows that a long call if it's combined with the riskless asset, is fundamentally equivalent to holding the stock and buying the put.
And portfolio managers have to constantly monitor this relationship to spot arbitrage opportunities.
Even if they're smaller than transaction costs, they signal mispricing in related products.
And this insight reveals why early exercise of an American call option is usually undesirable, even if it's deep in the money.
Well, for an American call, exercising early just means the holder forfeits the remaining time value.
That valuable opportunity for the stock price to rise even further.
Exactly. By waiting, the option maintains its intrinsic value plus that remaining positive time value. The only scenario where early exercise of a call is advantageous is just before the ex-dividend date for a very large imminent cash distribution.
Where the dividend received outweighs the time value forfeited.
Right.
However, the early exercise of an American put option is a different story.
It is. Early exercise of a deep-in-the-money put may be advantageous. When the put is exercised, the holder receives the intrinsic value, E minus S, in cash immediately.
And that cash can then be invested at the riskless rate to earn interest.
Right, interest income until the original expiration date. The sources confirm this happens when the interest income earned on that intrinsic value is greater than the remaining time value. This is a crucial distinction for managers who are holding American options for insurance purposes.
These parity relationships underpin the great valuation models. Let's look at the conceptual foundation first, the binomial model.
The binomial model is, it's really elegant because it simplifies the world into these discrete time steps where the security price can only move up or down by known factors.
And by constructing a perfectly riskless hedge portfolio.
A combination of the underlying security and the option.
The model guarantees a fixed payoff, regardless of whether the price moves up or down.
Precisely. And because the payoff is fixed, the present value of that payoff must equal the initial cost of creating the hedge portfolio. That's how it determines the option's fair price and eliminates arbitrage.
And the power of the binomial model is its capacity to handle American options.
Because it allows us to test at every single time step whether early exercise is desirable.
The most famous and still dominant valuation tool is the Black-Scholes model.
The Black-Scholes model is the theoretical limit of that binomial process. It assumes continuous compounding, continuous trading, and a perfectly continuous price path for the underlying asset.
And the formula, C equals S0 ND1 minus E to the negative RT ND2. It shows the price is driven by 5 parameters.
The security price S0, the exercise price E, interest rate R, time to expiration T, and of course volatility sigma.
Let's provide some intuition on the terms ND1 and ND2. These are the probability-weighted components of the option's cash flows.
Right, so ND2 represents the risk-neutral probability that the option will finish in the money.
The probability that S will exceed E.
Yes. ND1 is related to the probability of exercise, but it applies the probability weighting to the future stock price, which is then discounted back to the present. The first term, S0ND1, represents the expected present value of receiving the stock, conditioned on the option expiring in the money.
And the second term is the expected present value of paying the strike price.
Also conditioned on the option expiring in the money. So the call value is just the difference between the expected receipt and the expected payment.
And volatility, sigma, is the only non-observable parameter in all of this, which is why implied volatility becomes such a crucial market input.
Implied volatility, or VIVA, is the volatility level that, when you plug it into the Black-Scholes model, generates a theoretical price exactly equal to the current market price of the option.
So the market consensus forward-looking estimate.
It is a forward-looking estimate of the future standard deviation of the underlying asset's returns. Managers use IV to assess expensiveness. If the IV is higher than your own historical volatility estimate, the option is probably overpriced.
We also have to address options on futures contracts, which are valued using the Black model, a modification of Black-Scholes.
Right. Options on futures are distinct because exercise establishes a position in the futures contract, not the underlying cash security.
And their put-call parity is similar but adjusted for the futures price.
It replaces S0 with the futures price, F. But the critical behavioral difference relates to early exercise. Unlike cash calls, early exercise can be desirable for both deep-in-the-money futures calls and puts.
Why does the immediate payoff change the calculus here?
Well, upon exercising a deep-in-the-money futures option, the investor immediately gains the intrinsic value F minus E or E minus F in cash via margin adjustments.
And that cash is then available to be invested to earn interest.
Immediately. With cash options, you have to wait for settlement or sell the stock. With futures options, the cash is available right away, making the interest opportunity cost large enough to potentially overcome the lost time value.
Moving to active risk monitoring, we have to discuss the Greeks. These are the portfolio sensitivity measures that are essential for professionals running dynamic hedges or managing complex option portfolios.
They are the language of precise risk control.
These measures quantify how the option price or a portfolio's value changes in response to marginal changes in the key external parameters. Let's start with delta, the foundation of active hedging.
Delta measures the change in the option price per unit change in the underlying security price. For a call, it ranges from 0 to 1. For a put, from 0 to -1.
And delta is the bedrock of delta-neutral hedging.
Which is constructing a portfolio such that the long and short option positions, when you sum them up, yield a net delta of 0. This makes the portfolio instantaneously insensitive to small first-order price movements in the underlying asset.
And the put-call parity relationship gives us that analytical linkage. Delta of the put equals delta of the call minus 1.
That's the one.
But relying only on delta is insufficient. We need gamma, or E, to measure the stability of that hedge.
Gamma measures the rate of change of delta. It's the second derivative of the option price with respect to the security price. If gamma is high, the portfolio's delta is highly unstable, which requires the hedger to rebalance frequently.
And gamma is highest when the option is at the money.
Which means at-the-money options are the most dynamically sensitive.
This is where that analogy of steering a car at high speed comes in.
Exactly. If your car has high gamma, the steering wheel is extremely sensitive. A slight turn of the stock price requires a massive, immediate correction to your delta hedge, forcing you to constantly buy or sell the underlying asset or futures contracts.
So a delta-neutral portfolio with negative gamma will experience losses if the underlying price moves significantly in either direction.
And that forces the professional manager into a high-frequency trading loop just to maintain the hedge, incurring continuous transaction costs. It's a real problem.
We also have theta, the measure of time decay, which is the constant enemy of the option buyer.
Theta measures the rate at which an option loses value per day due to the passage of time alone. And just like gamma, theta decay is most pronounced when the option is at the money, and it rapidly accelerates near expiration. A manager who is long options needs to constantly generate returns just to counteract that daily loss of time value.
And then the sensitivities to external economic variables, rho and vega.
Rho quantifies the sensitivity of the option price to changes in interest rates. Our calls are positively sensitive, puts are negatively sensitive. And vega, sometimes called kappa, is the critical sensitivity to changes in the underlying securities volatility, sigma.
And vega is also highest when the option is at the money.
It is. So if a manager is short volatility, maybe running a large covered call program, they have negative vega exposure.
Meaning they lose money if market volatility rises.
Which highlights the need to hedge that specific exposure.
The investment implication here is, well, it's profound. Sophisticated risk management demands moving beyond simple delta neutrality.
To construct a precise total hedge, the kind required for, say, statistical arbitrage funds or dedicated volatility strategies, a portfolio has to strive to be delta gamma vega neutral.
Which requires combining multiple derivative positions with dissimilar sensitivities.
To nullify the portfolio's reaction to small price moves, that's delta. Changes in the speed of those moves, that's gamma. And changes in market uncertainty, that's vega. Achieving this state requires constant calculation and rebalancing, which is where true alpha is either extracted or lost.
Let's revisit the idea that the option contract itself is just one way to achieve this asymmetric payoff. We can also create synthetic options using linear instruments.
Right. The first method, which comes right out of put-call parity, is creating synthetic securities. We can replicate a long call option by holding a portfolio of long stock plus a long put, plus borrowing cash, the present value of the strike price.
And this is useful when one instrument is severely mispriced or illiquid relative to the others.
Exactly.
The second and most technically demanding method is dynamic option replication.
Dynamic replication involves trading frequently between the risky security and cash to recreate that nonlinear convex payoff profile of an option, but using only linear instruments.
So to replicate a protective put payoff,
the manager has to continuously hold a portion of the stock equal to the associated call option's delta. And because the call delta changes constantly as the stock price moves, the manager has to continuously adjust the portfolio mix.
Buying more stock as the price rises and delta increases.
And selling stock as the price falls and delta decreases.
That sounds like a strategy where you are perpetually buying high and selling low, which is kind of counterintuitive for making a profit.
It is. And that continuous trading, or the cost of constant rebalancing, is mathematically equivalent to the option premium. By dynamically trading the underlying asset based on the theoretical delta, the manager is synthetically creating the nonlinear payoff of the option.
And your success relies entirely on your ability to execute trades quickly and accurately.
And to handle the continuous transaction costs and slippage inherent in those high-frequency adjustments. This process really reveals that the core value of an option is simply the cost of this dynamic hedging process. So, to summarize the analytical core for our professional audience. Futures and options, they provide complementary tools for managing investment risk and customizing return patterns.
Right.
Futures, with their linear payoffs and pricing governed by that robust cash and carry mechanism, are ideal for efficient risk transfer and synthetic asset creation.
All based on the cost of carry.
Right. And options, governed by put-call parity, use their asymmetric, kinked payoffs to allow for sophisticated risk shaping, enabling managers to really fine-tune the skewness and the distribution of their portfolio returns.
And the strategic choices we discussed, from balancing the cost of carry and the implied repo rate to determining the optimal hedge structure, are fundamentally decisions about which specific risk is most palatable, given your market view. Do you choose the certainty of known basis risk, the stack hedge, or expose yourself to the unknown volatility of the forward interest rate term structure with the strip hedge?
Or do you sacrifice high upside for current income and volatility reduction with a covered call?
Or pay the premium for guaranteed downside insurance with a protective put? The optimal decision is always relative to your forecast of forward interest rates, market direction, and, of course, implied volatility.
And what becomes really clear through studying these mechanics is that the distinction between these instruments is, well, it's blurred by modern portfolio management. Dynamic replication shows that you can recreate an option's payoff using only linear futures and stock.
While generalized hedging ratios allow futures to surgically adjust portfolio duration and beta.
So the true skill lies not merely in valuing these instruments based on black skulls, but in determining the optimal portfolio sensitivity, delta, gamma, vega, and rho, that's required to achieve a desired calculated risk-adjusted return profile in a rapidly changing market regime.
The ultimate provocative thought for you to carry forward then. If a portfolio is truly committed to risk optimization, aiming for a delta gamma vega neutral position to mitigate all first and second order risks, that effort requires constant, expensive rebalancing.
It does.
Does the stability and effectiveness of your chosen risk-adjusted return profile rely less on the initial strategic decision, the structure of the option or future you chose, and more on your team's computational capacity and trading speed to manage the continuous, complex, and high-frequency change in those sensitivities?
The instruments are merely tools.
True alpha is extracted in the continuous dynamic management of their shifting risk parameters. Thank you for joining us for this deep dive.